Hello, I'm Kay McLellan, reporter on Mortgage Solutions, and welcome to our regular series of head-to-head interviews with industry experts on the current issues facing the mortgage market. Today we welcome Paul Broadhead, Head of Mortgage Policy for the Building Societies Association. The FSA has just published the Mortgage Market Review consultation paper on responsible lending, and lenders have reacted strongly to the proposals on affordability assessments and the demise of fast track and self-cert. But just how radical change will this really be for the market?
It could be hugely radical. We know that most people should be able to prove their income, and actually it's fundamental that people can afford to repay the loans. But what the FSA say is that almost half of the people at the height of the market either couldn't or didn't provide proof of income to their lender. Now, most of these people are not in arrears at the moment. The low arrears statistics and the low repossession statistics show that. So we could really be storing up a problem where we create mortgage prisoners later, people that cannot remortgage onto lower priced deals because they haven't got the documentation. So flexibility is absolutely the key. The other issue for the FSA is when to implement this. They've got to implement it at absolutely the right point in the market. We've already seen changes made to prudential regulation, we've seen supervision enhanced, and we don't yet know what the full impact of those are. I think the FSA should assess fully the impact of the changes they've already made before railing ahead and then just targeting new rules where there's persistent consumer detriment.
The FSA has just imposed a buffer for credit-impaired borrowers, restricting how much they can borrow by up to 20%. Do you think this is a sensible move, or is it the final nail in the coffin for the subprime market?
I think it needs thinking through seriously what are the FSA trying to achieve here. Are they trying to kill off the subprime market? I don't think that's their intention, but unless they think this through carefully, they could effectively do that. By further restricting the borrowing that subprime borrowers can make, could prevent people from either remortgaging out of difficulties, preventing people remortgage later down the line, or even get a mortgage at all in the first place. So it could have an impact. And of course, coming out of the deepest recession for generations, we are going to see an increasing number of people without a super prime credit rating because of the number of unemployment. We've still got further unemployment to come through from the public sector. So people could have bits and pieces of adverse credit on their record through no fault of their own. So it will have an impact, and just seriously need thinking through.
Do you foresee lenders relying more on intermediaries when making affordability assessments?
I think it's an interesting question, isn't it? What's the outcome of this be? And if you ask the FSA that question, their answer would be no, I think. They say lenders should be ultimately responsible for assessing the affordability of the borrower. But I think in practice, any responsible intermediary, when assessing the suitability of a loan for their borrower, would want to make sure that they can afford it, would want to make sure that they can meet all of the lender's criteria, which now is going to include income verification and affordability. So I think we really need to define what the role of the intermediary is going to be going forward, which the FSA will consult on towards the end of the year, and what the role of the lender is in all of this to make sure the relationship works well. I think there'll be a mix between intermediary business and direct business, as we see today, depending on what the business model of the particular lender is, what their target market is, where we end up with advice at the end of the year, and so on and so forth. So it will have an impact, but again, things are not clear because we've got this drip-fed consultation that isn't really coherent at this point. So let's hope it is by the end of all of the consultation papers.
Interest-only mortgages are also under scrutiny by the FSA, and several lenders have recently changed the capital repayment vehicles they allow. In light of the current economic environment, is it only right that this type of deal will be increasingly restricted?
I think it's likely that that kind of deal will be increasingly restricted. Whether it's right or not depends on the circumstances of the borrower. Interest only originally started really for in the endowment times where people could take out an endowment, have an interest only, and were hopeful of having a surplus at the end of that. Of course, it didn't pan out quite like that. But there are borrowers that interest only is absolutely suitable for, and I think the FSA needs to be very, very clear what is the problem they're trying to solve. Are they concerned that interest-only borrowers are more likely to go into arrears? Because I don't see that. I don't see interest-only borrowers being in more arrears than capital and interest borrowers. Is it that they're concerned about affordability, and these are just the interest-only mortgages are just being used to circumvent that, or are they worried about storing up trouble for later with a lack of repayment vehicles? So it will restrict it. Quite how big the impact is, we don't yet know. But one note of caution for the FSA: it is very, very valid for lenders to transfer borrowers facing repayment difficulties onto interest-only mortgage to help them over that period of time, and that's a tool that we wouldn't want to be restricted inadvertently going forward and compounding problems of people paying the mortgages.
Paul, thank you very much.